This segment is going to look at the use of internal controls when handling cash. Because cash is an asset that is highly susceptible to theft, companies place a heavy emphasis on ensuring that internal controls are in place to watch over and ensure cash does not disappear. For example, when companies have a lot of cash being received over the counter, a cash register is typically locked in with a record of transactions. So anytime a sale is made to a customer, the register keeps track of the amount of cash that should be contained within. Then the cash register records are compared to the cash that is reported at the end of a cashier's shift. For cash that is received by mail, typically what happens is companies establish the cash receipts between two employees. Those two employees maintain two different roles. Money that is received goes to a cashier's office. The cashier's office totals the cash and then sends the information to the accounting department, and a copy of that list is then filed. This segregation or separation of duties ensures that one person cannot open the mail and pocket the money. When we are dealing with cash disbursements, different types of internal controls are implemented. These internal controls are ensuring that all expenditures are made by a check, which provides some kind of trail of documentation. Historically, that's been paper. Nowadays, with EFT and auto type payments, these type of paper trails are not really paper anymore, they're digital trails. We also have separate authorization for check signing and record keeping duties. We do not want one individual being able to sign checks and then keep track of the recording of those checks as well. That enables somebody to create fake checks and pay themselves. We use a voucher system, and that voucher system ensures that there's a separation of duties and a paper trail. And a voucher system ensures that transactions are verified, approved, and documented. This ensures that payment is only made and documented for approved obligations of the business. So looking at a visual of a voucher system, we would see that when an initial purchase is begun, a purchase requisition or a request to make a purchase is created, and that is sent to the purchasing and accounting department. The purchasing department then seeks approval for that purchase, and once the approval is made, a purchase order is created. That purchase order goes to the supplier and the requesting, receiving, and accounting departments within the business. Once the goods are received, an invoice comes along with, and that invoice is sent to accounting. And the receiving department counts the goods and ensures that all goods ordered were received and creates a receiving report. The invoice and the receiving report both go to accounting, who match them. And then the accounting sends the invoice that has been verified against the receiving report onto the cashier to get approval. And then the cashier creates a check, and that check is then sent to the supplier vendor. What we're seeing here is a trail of not only paper or digital types of documents, but there's also a series of approvals, verification, and separation of duties. So not one individual is looking over the entire purchase order process.